Debt versus equity. How the rich leverage debt to build empires. In the world of wealth building, there are two primary sources of funding that entrepreneurs, investors, and business moguls utilize to scale their businesses: debt and equity. Both options come with their own set of advantages and disadvantages, but when used strategically, they can be incredibly powerful tools. For the rich, debt, in particular, often becomes the preferred weapon to build, expand, and consolidate empires. Understanding the difference between debt and equity financing and how the wealthy leverage debt to create their fortunes is key to unlocking the secret to their success. The basics of debt and equity. Before diving into how the wealthy use debt to their advantage, let's first define the key concepts. Debt financing refers to borrowing money from an external source, such as a bank or private lender. In exchange for the borrowed funds, the borrower agrees to repay the loan over time with interest. If the borrower fails to repay the debt, the lender can claim assets or take legal action. Equity financing involves selling a portion of ownership in a business in exchange for capital. When a company raises equity, investors gain a stake in the business and, often, a share in its profits. However, equity financing means diluting ownership and sharing control with investors. While both are essential in the financial landscape, debt has distinct advantages that the wealthy understand and use to their benefit. Why the rich prefer debt financing. 1. Retaining control. One of the most attractive aspects of debt is that it allows business owners to retain full control over their company. When entrepreneurs use debt to finance their operations or expansion, they do not have to give up ownership or share decision-making power. In contrast, raising funds through equity means parting with a portion of the company, which could limit the entrepreneur's ability to make independent decisions. For the ultra-wealthy, who are often driven by a desire to maintain autonomy in their ventures, leveraging debt is crucial. They are less inclined to dilute their ownership and will use debt to finance ventures while still keeping the reins firmly in their hands. 2. Tax advantages. Another reason the wealthy leverage debt is the tax benefits it offers. Interest payments on business loans are generally tax deductible, which can reduce a business's taxable income. This makes debt financing more attractive because, instead of paying taxes on profits, the business can deduct interest payments as expenses. The wealthy are keen on finding ways to reduce their tax burden, and using debt to finance their ventures allows them to keep more money in their pockets, increasing their overall returns. 3. Building leverage. Debt financing allows the rich to amplify their returns on investment. By using borrowed money, they can make investments and fund businesses that would otherwise be out of reach. This strategy is often referred to as using leverage. Leverage means that a person or business is using debt to increase the potential return on an investment. For example, an entrepreneur may use debt to purchase real estate or expand a business. If the investment grows in value or generates higher profits than the cost of the debt, the entrepreneur makes a substantial return on their equity stake in the business. Leverage allows for rapid wealth accumulation because it enables individuals to control larger amounts of capital with less initial investment. 4. Diversification. By leveraging debt, the wealthy can diversify their investments across various industries, sectors, and geographical locations without committing large amounts of their own capital. They can take on multiple high-value projects or investments simultaneously, spreading their risk while maximizing potential rewards. For instance, a wealthy individual might use debt to invest in real estate, stocks, startups, or even acquisitions. This gives them access to a variety of assets that might appreciate at different rates, thereby balancing the risks and rewards associated with each. How the wealthy use debt to build their empires. 1. Real estate investment. Real estate is one of the most common ways the rich use debt to build wealth. By using mortgage loans to finance real estate purchases, wealthy individuals can own significant properties with a relatively small down payment. As the property appreciates over time, the investor can sell it for a profit, repay the loan, and keep the difference. Moreover, rental properties provide a steady stream of cash flow, which can help service the debt and create long-term wealth. For example, many famous billionaires, such as Donald Trump and Robert Kiyosaki, have used real estate as their primary wealth-building strategy, using debt as a tool to acquire vast portfolios of properties. 2. Private equity and leveraged buyouts. In the world of corporate finance, private equity firms often use leveraged buyouts, LBOs, to acquire companies. This is a prime example of how the wealthy use debt to build their empires. In an LBO, a private equity firm borrows a substantial amount of money to acquire a company, using the company's assets as collateral for the loan. The private equity firm then takes control of the company, reorganizes it, and eventually sells it for a profit. In many cases, the wealthy investors don't use their own money to make these acquisitions. Instead, they rely on the ability to borrow at favorable interest rates, using the acquired company's future earnings to pay off the debt. The success of this strategy is dependent on the business's ability to generate sufficient cash flow to cover the debt repayments, but when done correctly, the returns can be astronomical. 3. Debt in the stock market. The rich are also adept at using debt to invest in the stock market. Known as margin trading, this strategy involves borrowing money from a brokerage to buy more stocks than what the investor could afford with just their own capital. While this approach amplifies the potential return, it also increases the risk of losses. However, for experienced investors, margin trading can be a highly effective tool for leveraging their investments. When used wisely, it allows them to capitalize on market movements without having to put up large sums of money upfront. 4. Corporate debt issuance. Large corporations, particularly those led by wealthy founders or owners, often issue bonds to raise capital. By doing so, they can secure funds without giving up ownership or diluting shares. The bondholders are paid interest over time, but the company maintains control of its operations. Many billionaires and corporations issue bonds as a way to fund expansion projects or acquisitions. By leveraging low interest rates, they can borrow at a fraction of the cost, increasing the value of their business with minimal financial outlay. While debt is often seen as a risk, the wealthy understand how to use it as a tool to build, grow, and expand their empires. They leverage debt to retain control of their businesses, benefit from tax advantages, amplify their returns, and diversify their investments. By carefully managing their debt, they can access capital on favorable terms and use it to fund opportunities that drive long-term wealth creation. For the average investor, debt might seem daunting. However, understanding how the rich use debt strategically to build empires is essential for anyone looking to unlock the secrets of wealth creation. With the right knowledge, anyone can learn to leverage debt as a powerful tool for financial success, just like the world's wealthiest individuals. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.